6.25% exposure to Bitcoin. The problem I have with like 1 or 2% exposure is it doesn't move the needle for me. The turning point was once we got Bitcoin in an ETF and a BlackRock ETF, that meant that the whole universe now could buy it. Before iBit, I think you could be a skeptic and come out and say, hey, I think Bitcoin is a Ponzi scheme, it's going to zero. And you could make that argument. Bitcoin is going to be like every other asset class, but it's going to be more volatile. Yeah, I mean, it had a 50% drawdown. The S&P 500 had a 60% drawdown in 2008 because, I don't want most of Bitcoin's upside. I want all of Bitcoin's upside.
Hey everybody, Tyler back with the BitcoinTreasuries.net podcast, and today I'm joined by Matt Tuttle. Matt runs Tuttle Capital and manages what, Matt? Something like $4 or $5 billion. And you've got some pretty interesting trading strategies I know that we're going to get into, but welcome to the show, Matt.
Hey, thank you very much for having me.
You got it. So you've been trading since the 80s. You kind of went to Wall Street in 1990. So you've seen, being in around trading equities, trading different strategies, you've seen a lot of fads come and go. Of course, our viewership is into Bitcoin. You've also seen a lot of trends that have some staying power. So I guess personally, how are you playing Bitcoin right now? And what do you make of this kind of wild child that Bitcoin's been and is kind of growing up before our eyes?
Yeah, so really to me, or for me, the turning point was iBit. Once we got Bitcoin in an ETF and a BlackRock ETF, that meant that the whole universe now could buy it. So, before then, I'm way older than you. The way to buy Bitcoin is, you open up a Coinbase or whatever, you've got your cold wallet. A guy like me, I'm not going to do that. That's not my comfort zone. It'll probably never be my comfort zone. You put it into an ETF, I'll buy it all day, every day. Now the Merrill Lynch advisor can buy it. The Morgan Stanley advisor can buy it. Pair that with the fact that we've got, a crypto president, basically. You've got an SEC that's pro-crypto. I think this is an asset class that has staying power. Before iBit, I think you could be a skeptic and come out and say, hey, I think Bitcoin is a Ponzi scheme, it's going to zero. And you could make that argument. I don't think you can make that argument anymore. Now, is Bitcoin going to 1 million? No idea. It could. It could go to 10,000. It could go anywhere in between. But we do believe that Bitcoin now belongs in client portfolios. We've got ETFs around it. We have BEGs, which is Bitcoin, Ether, Gold, and Silver. In our wealth management firm, we have allocations to BEGs, so Bitcoin and Ether. So we do now think it's something that you ought to have in your portfolio.
Yeah. I think I try to do this run this exercise every so often where I look back in like 2020 2021. If you told me we'd be in the position we're in now with the market's posture towards Bitcoin, I would have said you're crazy, and I was as bullish as they come on Bitcoin, I'd say. But yeah, I think the ETFs, major investment banks getting involved with Bitcoin and packaging it up, like you said, in something that's just accessible to everyone, from traders, investors who can just go into their brokerage account and click buy and get some Bitcoin exposure without, like you said, having to go through an exchange, learning how to set up a wallet. Well, those are things that I certainly promote as a Bitcoiner. Like these products are just complete game changers in allowing the asset to really flourish. I talked with Robbie Mitchnick, who's a managing director at BlackRock, just this past week on the podcast, and it got me fired up to hear like so many of the they're talking with investors all the time, and people they're recommending allocations, like you said, to Bitcoin.
Yeah.
As low as 1 to 2% with some people, but there's
And
bigger.
we're actually higher
Yeah,
in
yeah,
client portfolios. We're, 6.25% exposure to Bitcoin. The problem I have with like 1 or 2% exposure is that doesn't move the needle.
yeah,
Um, you know, Bitcoin could be a lot of things. Some people argue, well, it's this, it's this, it's this. Yeah, sometimes, but I do think it's a portfolio diversifier. So I think, for a portfolio diversifier, you need a meaningful allocation. So that's why I think it's got to be more than 1 to 2%.
yeah, yeah. I think that's well said. And there's even like family office advisors who have allocations up there in that 5, 10, 15% range or higher, and it's just cool to see like kind of that array of different theses around it. And I think you're right. It's got to be a big part of that portfolio. Maybe you can talk about, your broader, I guess, portfolio construction theory. You know, you've said on some previous episodes of different podcasts that I caught that you're a trader at heart. But how do you think about portfolio construction broadly? And maybe you can run us through the heat formula, Matt.
Yeah, so we've got a process, as you said, the heat formula. It's something that we write about in my daily newsletter. It's something we implement in our wealth management firm, Tuttle Wealth Partners. And I've got a book coming out about it, probably first quarter next year, is when the book will be out. And it's how I manage my money. And it stands for hedges, edges, asymmetry, and themes. Hedges is you should always have hedges. You have no idea what the market is going to do. One of the benefits of being around for so long is I've seen everything. So if you try to tell me, hey, this can never happen, it's going to. May not be tomorrow or the next day, but anything you can think of that you're like, no, never going to happen, it will. And bonds are not a hedge. So we are big, big not believers in bonds. Edges is simply be the casino, not the gambler. The gambler loses. Over time, the casino wins. Asymmetry is everything you do should be structured so that heads you win a lot, tails you lose a little. And then the T is themes. You should always be positioned in today and tomorrow's top themes. Now, you can take heat formula concepts and apply it to whatever you want. What we then do is we take it a step further and we look at the classic permanent portfolio idea that was designed decades ago by this guy, Harry Brown. And what he came up with was this all weather type of portfolio: 25% stocks, 25% bonds, 25% gold, and 25% cash. We've modernized that. So 25% stocks, thematic, balanced with, these AI types of names, balanced against things we call Halo, heavy asset, low obsolescence, and Lindy, companies that have been around for 100 years. Then we look at what we call better than bonds. We don't like bonds. What I do like is property and casualty stocks, and I like pre merger SPACs. Then we look at what we call the hard money hedge. That's half precious metals, half crypto. Because why I like Bitcoin and a little bit of Ethereum in a portfolio is really as a hedge against hard money currencies. I think all of this debt you've got sloshing around, deficits, more and more you're going to see people wanting to move away from dollar, euro, yen, and going into gold, silver, Bitcoin. And then 25% what we call tail risk. So, and the tail risk is things that will go up when the market goes down. So that's how we look at portfolio construction.
Yeah, really interesting. A lot of threads I want to pull on there. So yeah, interesting that Bitcoin fits into that edge bucket, and yeah, I think it makes sense, right? In a world of increasing, government budgets and kind of free money, it does seem like to lean into an edge on a asset that will thrive in that environment is definitely a way to play it. You talked about AI kind of being in that thematic bucket, right, Matt? Um, how much do you think, with Bitcoin's price drawdown at the end of last year and this year, and AI's just, it seems like AI's just sucks so much air out of the room, um, and along with the SpaceX IPO, do you think that trend continues? Are we going to see maybe a little bit of a bubble pop there before we see, Bitcoin rise again? And how is the interplay between AI, versus people who would otherwise be, putting those, I guess, dollars into the Bitcoin ecosystem? How has that interplay developed from your seat?
So yeah, I mean, I think there is some, you could certainly make an argument that, memory, photonics, stuff like that sucked the oxygen out of Bitcoin. And, for a while it was way more interesting to talk about Micron and Hynix and, companies like that than it was Bitcoin. I think the bigger problem is Bitcoin did what any asset class does, and being a volatile asset class, it topped, and it just, and this is what we're seeing right now in the memory trade. Things get crazy. And so what you saw with Bitcoin last year is everybody and their brother decided, I'm going to be the next Michael Saylor. I'm going to do this digital asset treasury company. Money pumped into that, and you just got this massive leverage that blew Bitcoin up to 120, or maybe higher, whatever it topped out at. And all of that stuff ends badly. People have to unwind the leverage, people get margin called, and then you have, basically it's shouting fire in a crowded theater. Everyone's in the theater, one door, we all got to get out at the same time. When the margin guys are calling, you've got to meet that call, you've got to sell. And that's what happened. And then, that's what you saw in the memory trade and the photonics trade. So, Bitcoin is going to be like every other asset class, but it's going to be more volatile. So, yeah, I mean, it had a 50% drawdown. The S&P 500 had a 60% drawdown in 2008. It's just going to happen. The time to be buying, anything is when people don't want it. If you're buying all the way up through this whole leverage cycle, bad stuff's going to happen to you.
Yep. Yeah, I got a cop to in one of my accounts finding out that margin calls are real this past year. So that was a nice educational moment for me. But yeah, thinking back again, you opened up a lot of questions here with like you said, there was so many dollars coming into Bitcoin. Everybody and their brother, as we covered, we're starting a public Bitcoin treasury company or digital asset treasury company. And we're kind of seeing like, who's going to survive the bear market, what cream is going to rise to the top, in the next bull market. And, in a sense, you can't blame, so many companies, hundreds of companies trying this strategy after they saw the success that Michael
No,
Saylor
I
had.
mean that's how the markets work. You see it in everything. So we saw it in SPACs. Back in 2022, everybody wanted to have their own SPAC. We had too many. The market collapsed. Same thing here. And it repeats itself. Again, the benefit of being around a long time, you see this stuff over and over and over again. It's not surprising. So at 120, everyone's like, oh my God, Bitcoin's going to a million. And then at 60, everyone's like, it's going to zero. Both of you guys are wrong.
Yeah.
You've
Yeah.
just got to understand how markets work.
Totally. You mentioned that you allocate to pre pre-merger SPACs as part of your strategy. I'm curious how did you play the kind of Bitcoin treasury? A lot of those treasury companies went public through some of the Cantor Fitzgerald SPACs. Are we going to keep seeing, these rotating boom bust cycles with SPACs? Like you said, 2022, we saw a cycle. 2025, in the Bitcoin treasury land, the SPACs were really hot, and that's obviously cooled off. So, what's your take on how do you approach investing in SPACs?
So, how you approach investing in SPACs is stick to the pre merger. So, how we played the Cantor SPACs, we got in at the IPO. So, we get in at 10 and, we rode those up. And once a merger was consummated, so the cool thing about a pre merger SPAC, just, back up a bit. So basically, in a pre-merger SPAC, I start a SPAC, you give me $10. That money sits in a bank account in T-bills earning interest. I go out, I find a private company to take public. I find a private company to take public. I come back to you. You've got a decision to make. Either you say, nah, not interested. And at a minimum, I get my $10 plus interest. Or, yeah, I'm interested. I'm going to hold. So what I would suggest is you buy these things as close to 10 as possible. We can get the IPOs. You probably, and your viewers probably can't, but you get them as close as possible. And then before a merger is consummated, you're out. Once a merger is consummated, that $10 floor goes away. Until a merger is consummated, I know my downside. My downside is $10 plus interest. Going back to asymmetry, that's a beautiful asymmetrical trade. My downside is known, my upside is unlimited. But once that merger takes place, my downside is unlimited, my upside is unlimited. It's still an asymmetrical trade, but it's not nearly as attractive. So we're going to be out. And that's how we played those Cantor things. We got in at 10, we wrote them up, made our money, sold, rinse and repeat, on to the next thing.
Yeah, so you're out on that momentum trade prior to the merger, but after the announcement, essentially.
Exactly.
Yeah,
And
yeah,
and you hope you get a pop, and you hope the market treats that announcement, well. And in a lot of cases last year they did.
yeah. Those were fascinating as an investor last year because they did feel like a kind of an edge play, right? I don't have the trading chops you do, but it was
Well,
clear what was
and we've got
happening
an
with all those.
ETF for that. It's SPCK is
Oh,
the
cool.
symbol. The symbol used to be SPCX, but we ended up giving that one up.
I love that. Did you play any of the options that in those markets that appeared after the SPAC announcements? I know they're really shallow options books, but I dipped my toes in that and had some pretty pretty lucrative results. I'm curious if you
No,
played
I
the
mean
options in
we
those at all.
didn't want to get too cute. Sometimes we get units that have warrants attached,
Okay.
and then we'll separate the units. And we might, depending on the liquidity, the warrants are basically free, so we may hold on to them. Or if there's some liquidity and we can sell them for something, we may sell them. But that's not, the warrants aren't a big part of our strategy. And really, for reasons you mentioned, typically they're not very liquid. And our fund has like 8 million in it. So it's, you can't really, mess around with non-liquid stuff.
Sure.
And plus from a regulatory standpoint, we're somewhat limited to how much illiquid investments we can have.
Got you. When you do think about options more broadly as part of maybe your heat strategy, is that part of your edge bucket as well? And what types of things are interesting there? Are leaps ever on the table as part of a strategy, either personally or with your ETFs?
So I'm an options guy. I love options. In a perfect world, my entire portfolio would be options. I don't have time for that anymore. I mean, it used to be. I don't have time. the thing with options, you've got to watch them. Because I would always be agnostic.
It's official. The Bitcoin Treasuries conference lineup just dropped. Grant Cardone, Adam Back, Eric Weiss, the man who introduced Saylor to Bitcoin in the first place. Plus, the CEOs actually running the treasury companies and the macro voices calling out where the institutional capital goes next. 10 confirmed speakers, 1 closed-door room, September 28th in New York at Second. Save 10% on tickets today by using the code SECOND. Reserve your seat by scanning the QR code on the screen or visit bitcointreasuries.net/conference. We'll see you in New York.
I would always be agnostic. In fact, I tilted more to selling options than buying them, because selling options, to me, there you are, the casino, versus buying options, you're more the gambler. But when you're selling options, you got to be watching them all day, every day. And I don't have time to do that anymore. So now I just buy my ETFs. But I am a big fan of put credit spreads. So we've got a couple of ETFs, DRMP, which is our memory one, and SPCI, which is space, where we use options to get exposure to the stocks, but then we sell put credit spreads for income. And I'm a big fan of selling puts. I hate covered calls. I think covered calls are the opposite of asymmetry. You limit your upside and you still have unlimited downside. So we don't do any of that. Now, let me caveat that we do run a couple of zero DTE covered call ETFs, TDAX and TSYX. And I think that is the exception, because with zero DTE, you are doing it every single day. So at some point during the day, you're selling the option. At some point during the day, you're closing it out. So really, you're only giving up your upside intraday. But you've got the ability to make that decision every single day, and you preserve all of your upside overnight and over weekends. So I'm all right with zero DTE, but I don't like the covered call ETFs that are out there. Back when I started, covered call investing was, I'm going to buy Procter and Gamble, McDonald's, and Coca-Cola and sell calls. Got no problem with that. Those aren't
Sure.
asymmetrical stocks anyway. So who cares if you want to sell calls on those? Now you've got people, I'm going to sell them on Nvidia and, Tesla and MicroStrategy. I mean, those are stocks that could go up a gazillion percent. Why would you give away your upside?
Yeah, is that how you view like iBit as well in Bitcoin? Like, um, I guess there's a lot of people out there like saying we've got these products that give you most of Bitcoin's upside, and we're gonna like nibble on the income side of things.
Right. And I think the only way I'm going to do that, because I don't want most of Bitcoin's upside. I want all of Bitcoin's
Sure,
upside.
yeah.
The only thing I would do is stretch and SATA, where to me you've got something that's Bitcoin adjacent, and you're getting 11, 12%, and you don't have Bitcoin's downside, you don't have Bitcoin's upside, but you've got that yield. So those products I like. And while I said I don't have time to sell options anymore, when Stretch went into the 70s, I couldn't help myself. I sold puts. So every once in a while, the old trader in me, I'm looking at something, I'm like, all right, I got to do this. I know I don't have time to watch it, and it'll probably end horribly because I'll forget I sold the puts, and I'll get assigned or whatever. But I mean, so far I'm up like a ridiculous amount on them, because last I looked, Stretch was like 86 or something.
Yeah, yeah, absolutely crazy. And I've heard a lot of people who have just gone long some of those preferred equities, even down the capital stack, and on the other preferred equities that Strategy have, just because the yield is insane, right? Their balance sheet is collateralized by tons of Bitcoin, and if you've got a long Bitcoin thesis, like I can't blame anyone for just capturing a huge opportunity there. I talked to Strive CEO Matt Cole this past week. We released the episode midweek, and he talked about SATA and stretch, Michael Saylor's product that pays the dividend, like you said, 12, 13% on those products, as solving, like $100 trillion income problem in the United States. There's basically, with the debasement of the dollar, like you talked about earlier, Matt, like that's what Strive is doing. That's what Sailor's doing. They're trying to, attack capital markets and provide this vehicle that's backed by Bitcoin, but strips down the volatility in theory. Obviously that's been tested a little bit recently, but give some of that upside, some of those returns back to the investor. So, do you think that's? I'm curious of your take on that strategy generally that these Bitcoin treasury companies, Strive and Strategy, are doing. And there's one in Japan, MetaPlanet, who's also trying to do that. They've been able to raise tons of capital. I mean, Strategy raised billions of dollars this year to buy Bitcoin just by ATMing this preferred equity, which is kind of like the ugly stepchild of equity markets. So yeah, I'm curious, like, is that something that these companies are going to be able to do, and how does that make you think about the, I guess, common shares of those companies as well? Looking at Bitcoin's chart over the past year, we've seen some clean structural trends. Most of you hodl long-term like I do, but to trade short-term moves, the easiest way is with Kalshi perps. Sometimes I'm sure that next leg in Bitcoin's price is just around the corner, and perps allow me to position for that exact scenario. Kalshi has a CFTC-regulated U.S. exchange that are bringing perpetual futures to American traders for the first time. Perps let you trade Bitcoin's price movements up or down with no fixed expiration dates, unlike typical futures contracts. So I can take my leverage up to 6x without even holding spot, and that can amplify both my potential gains and potential losses. Leverage trading obviously isn't for everybody, so carefully consider your own financial circumstances. Scan my QR code on screen or sign up at kalshi.com/p/Bitcoin Treasuries. And as always, make sure you trade responsibly and don't forget to stay orange.
Yeah, in full disclosure, we partnered with the guys at Strive, and we have filed for an ETF that's going to be based on SATA and Stretch. And I wouldn't have done that if I wasn't a big fan. Now, would I go as far as Matt Cole and saying, "Hey, we've solved the income dilemma"? No, because I don't think there's anything you want to put your entire portfolio into. So we look at this, being digital credit as a component, and, is part of kind of that hard money hedge. So, again, I said I'm not a fan of bonds. This is an exception for me. And, this is also, a different asset class. It's got different risk reward than some of the other things out there. So I look at it as a complement to a Bitcoin position. And when this ETF launches, it will be a part of our client portfolios because, I love what that brings to the table. But it doesn't, as we've seen, get rid of all the volatility. You never do. Um, you know, and you saw where it seemed like, yeah, everything was great. I think Stretch only got into like the low 90s when Bitcoin was getting crushed. But
Yeah.
then this latest round, it went to like 72. And, it's one thing to look at it in a chart. All right, it snapped right back. Well, when you're the client and you're sitting there, that's painful.
Yeah.
So, that's why it can't be 100% of your portfolio. It can't solve the income crisis, but it can help. And so the way we solve it is something like that as a part of your portfolio, having these put credit spreads where now I can create an ETF that maybe has a 30% yield. That becomes a part of your portfolio. And now, so, the problem is you go to your traditional advisor, "Hey, I got $1 million. I want to retire." You can be like, "Great, Tyler, you can take out $40,000 a year." Like, wait, $40,000 a year. That's not going to pay for anything. unless I live in like Nebraska or something. So and it used to be if you had $1 million, you were rich. Now, if you've got $1 million, you're not even middle class. So what we want to try to do is, all right, not how can I give you 11%? Because that's, there are trade-offs there. But how can I give you 6%, 7, 8? How do I bend that curve to where maybe, all right, Tyler, it's not 40,000, it's 80. Yeah, all right, I can't live off 40. Bet
Mm.
you might be able to live off 80.
Right,
Throw in
right.
Social Security, assuming it's going to be there, which for you, I would not. For me, I mean, I'm 57. I don't think I'm going to see a cent, but I seriously doubt you're going to see a cent.
We'll,
But you
we'll,
never know. It might happen.
the millennials and Gen Z will bail you out. Don't worry, you'll see your check,
Oh
Matt.
yeah, I'm sure you'll want to have your taxes raised, 25% to give me Social Security.
I
And,
don't, but
and
I
you
may
won't
not
have a
have a
problem with
choice.
that at all.
They never listen to us. I'm curious about like the mechanics of a. I don't know how much you can talk about this digital credit ETF that you filed for. That's kind of pending approval, but maybe you can talk, generally about, like a leverage ETF on something trying to generate higher returns. What do the mechanics on the back end look like? Are you holding, you know, um, you know, the preferred equity? Are you doing total return swaps? How does that work?
Yes and yes. So ETFs are great for the end client. For the guy who's actually designing them, they're a pain in the ass because we've just got all these rules and regulations. Some of them make perfect sense. Others are artifacts of ancient times that never got changed. So to make this work, yes, we have to own some of the actual physical preferred, and then we do some on swap. And basically where this interested me is I look at something, all right, it's got a high yield and it's got a fairly low volatility. If you look at stretch and say to most of the time, again, every once in a while you get the sell off, but most of the time you've got a low volatility. So a guy like me thinks perfect for leverage. And in these products really are perfect for leverage. Now there's a cost to leverage. So it's not like, hey, I'm going to take something that's yielding 11% and give you something that's yielding 22. I can't do that. But we could take something that's yielding 11 and give you 14 or 15.
Yeah,
And,
yeah.
and that's the goal here is to give you a couple percent more in income without really adding a lot to the volatility.
That's really cool. I'm curious, what are your instincts on, like we said, there's current price dislocations aside, I think most of our viewers are pretty bullish on the digital credit model. Anyway, moving forward, in that par will be easier to regain, as Bitcoin's price trends up, and there's other factors that affect strategy and strive. But how much room is there for a third, fourth, fifth product in U.S. markets, maybe global markets, because of how successful Stretch and Seda have been at attracting capital? Do you think there's more room for digital credit products? What's your gut telling you?
My gut feeling is this is going to work like everything else. As strategy and strive get more and more assets, become more and more successful, it will drive more people into this. And again, it'll bubble up and eventually that bubble will burst. I think with everything, you stick with the higher quality stuff. We'll review everything as it comes out, but to me, there's no real reason to go beyond Stretch and Seda.
Yeah.
I'm sure other people come up with some interesting ideas. I might, every time this stuff happens, we look at it. So I've looked at doing a SPAC before. I decided not to. I looked at doing a digital asset treasury company. decided not to. I might look at doing something like this. I'll probably decide not to, but I'll look at it.
Yeah, yeah. No, we'll be keen to monitor that. If you do, let us know.
Yeah.
We'd be really happy to cover it and break that down. So, I want to talk about something that comes up in almost every conversation I have with Treasury executives. They get the Bitcoin thesis, they see the macro case, but then they walk into a board meeting, and the first question is, who's holding it? Are they regulated? Are they insured? Can we audit this? That's where BitGo comes in. BitGo is an OCC regulated national trust bank. That means they operate under the same federal oversight as the institutions your board already trusts. Your assets are held in segregated trust accounts, never commingled. They're secured in 100% cold storage with multi-signature architecture. If you're building a case for Bitcoin on your balance sheet, BitGo is the custody partner that turns a board conversation from why into when. Visit bitgo.com/Bitcoin-treasury to connect with their team.
You wished for it. Bitcoin is finally on sale. And if you're sitting on BTC and want liquidity without dumping your stack, Arch Lending can make it easy. You can get USD or USDC in minutes, and your collateral stays in qualified custody. They never rehypothecate your assets. As your assets move up and down in value, you can scale your credit line instantly or pull collateral back when the market runs. If you need help, you get real humans 24/7, not bots. This is Arch Lending. Simple tiers, public pricing. You can check them out at archlending.com.
We talked a little bit about like Bitcoin growing up, Bitcoin being institutionalized, digital credit's been, a part of that. ETFs, securitizing Bitcoin and offering derivative products has been a part of that. The regulatory environment, like you said, we came in the SEC is totally different than when Gary Gensler was there, under the prior administration. I mean, it was a sea change, and Bitcoiners everywhere were rejoicing that it's finally like it doesn't seem like the industry's under attack, and I think moving forward, it's not going to be in vogue to come down on Bitcoin and the broader crypto as an asset class largely. So, do you think because of that? Bitcoin's volatility will be dampened compared to the past. I mean, this last drawdown was, barely more than a 50% drawdown. Like you said, the all-time highs were 126, 127K. We hit maybe just under 60K in this drawdown, where traditionally Bitcoin, in drawdowns can hit 70, 75, 80% drawdown. So do you think those days are over and volatility is going to be dampened, especially on the downside?
Not yet.
No.
So every market has a degree of manipulation in it. In most of the time in like stocks or bonds, the markets are so big and so many players that you don't see it. And every once in a while there's something egregious where you're like, wait. But for the most part, you don't really see it. You see it in Bitcoin. For example, we had that, 10 a.m. thing, which, maybe it was Jane Street, maybe it was someone else, but every day at 10 a.m., Bitcoin was going to make a move. That's most likely some sort of market manipulation. You've got the fact that it trades 24 hours a day. So, I can put in something, some news story or some trade at like midnight on a Saturday when there's hardly any volume and move the market. So I don't think we're there yet. I don't think Bitcoin, the whole trading ecosystem is the same as the stock market, the bond market. So I do think we're going to continue to see more volatility, wild swings. I think eventually it matures and that stuff goes away, but I don't think we're there yet.
Yeah, makes a lot of sense. And yeah, it's funny when that Jane Street rumor kind of dropped. I couldn't get any of my buddies at Jane Street on the horn to talk about it.
Yeah,
I
and we
totally,
trade with Jane Street all the time, but
yeah,
we know, if Jane Street sees an opportunity somewhere, they're going to jump on it.
absolutely,
And
absolutely.
and there are other companies like that out there too that they're watching and they're waiting, and if they see something, they're going to do it.
Totally. Yeah, thinking about, Bitcoin's volatility a little further, Matt, if we could drill down there, Bitcoin's still under a $2 trillion asset at current prices, it pushed over 2 trillion, in the run up at the end of last year. Um, you said that you have an allocation to gold as well, and kind of treat it um, in that, kind of, is it in the hedge bucket? Is that right?
No, so I look at it as the hard money hedge. Well, hard money hedge, yeah.
Hedge. Yeah.
So
Okay.
you're not hedging the market. I don't think gold is a market hedge. I don't think Bitcoin is a market hedge. I look at those as a hedge against people just saying, I want out of fiat. I
Yeah.
don't trust dollars. I don't trust yen. I don't trust euros. I
Gotcha.
want something different. And that something different is either the thing that's been currency for thousands of years or, the new kid on the block. So I don't look at it where it's like, hey, gold, hey, Bitcoin. To me, it's both. The debate is fun. I was on Fox Business a couple months ago, and I'm sitting in the green room, and on before me, so they're both in the green room arguing with each other, is Schiff and Pompliano, and then they went on and they did a debate, and I'm sitting there like so friggin' stupid. It's not it's both. It's not either or. Sometimes gold is going to be doing better. Sometimes Bitcoin is going to be doing better. Bitcoin is not digital gold. Bitcoin is its own thing. You want to have an allocation to both. You set it and you forget it.
Yeah. Yeah. Yeah, those conversations always make me laugh with Pomp and Peter Schiff, and he Bitcoiners are always tweaking him, so that I get a kick out of that. I bet I followed Peter Schiff, kind of in the wake of the great financial crisis, and was interested in a lot of like his political takes and ideological takes, and I followed the guy for a long time, and yeah, it's interesting to see how he reacts to Bitcoin. So you said Bitcoin's not digital gold, um, and you're not sure, that Bitcoin will go to say $1 million, anytime soon. But let's just like forecast that, in a decade, a couple decades, Bitcoin somehow does catch that market cap of gold. I don't know if you think that's realistic in any world. I certainly do. A lot of, I think our audience probably does, but a lot of your audience are also gold investors too. But let's say it does catch up realistically to that gold market cap. Will it be traded more similarly to gold in that situation, or is it just destined to be different?
So, yeah, I mean, could Bitcoin catch up to gold? Yeah. I mean, like I said in the beginning, anything can happen in markets. And, anyone sitting here trying to predict it, yeah, you're going to get it right every once in a while, but you're not going to always get it right. And something like Bitcoin and gold too. I mean, gold, at least we have some history of ratios, but, how do you forecast Bitcoin?
This episode is brought to you by Kalshi. And here's what keeps bringing me back to Kalshi Perps. I don't sell my Bitcoin, ever. But there are weeks where I've got a strong short-term view and no clean way to act on it. That's the gap perps fill. Kalshi is a CFTC-regulated U.S. exchange, and it's the first time Americans can access perps on shore. You take a position on whether the price goes up or down with no fixed expirations. You close when you want, and I can go up to a 6x multiplier, which amplifies both my gains and my losses. So I size small, I set my stop before I open anything. Leverage trading isn't for everyone, so carefully consider your own financial circumstances. Scan my QR code on screen or sign up at kalshi.com/p/Bitcoin Treasuries. Trade responsibly and stay orange. Yeah.
You know, like a
Gold
stock.
has the Lindy effect. Like, yeah,
Right.
yeah,
But
yeah.
a stock, has earnings and it has a multiple. And even then, I can't forecast the stock. All the brokerage firms will try, and they're always going to get that wrong. So, trying to forecast where Bitcoin is going to be is a fool's errand. Will it trade like gold? I don't think it will, because I think the people who are investing in gold, trading gold, are different than the people who are buying Bitcoin. So you and your readers, you guys are buying Bitcoin. whereas you've got central banks buying gold. Now, a central bank is different. They're not a profit maximizer. You're buying Bitcoin hoping it's going to go up. A central bank might be buying gold for an entirely different reason. You don't have a guy sitting at a central bank, looking at a chart, trading gold on a chart. They're just, hey, we need to add to our gold reserves. We maybe want to get out of treasuries. We don't trust treasuries. Where are we going to put our money? We're going to put it in gold. I got to think the guys who are following Peter Schiff are different than the guys who are following Pomp.
Definitely. Yeah.
So I don't think they're going to trade alike, and I hope they don't. I like having them both in a portfolio because they do different things. Once they start looking and smelling the same, then the diversification effect is much less.
Yeah. Yeah. To put a bow on that, like it's a flimsy thesis, but my thesis is that I think long term, just because of demographic shifts, that Bitcoin can flip gold because of kind of how these younger generations view it compared to our dads, our granddads in their gold allocation. Not to dump on gold, because I think gold has been it has a rightful place in a portfolio and has done something different. It's got strategic value, like you said, to governments. But yeah, I do think there's demographics at play as well, kind of transfers over the coming decades that might make that a reality. But that's that is a really cloudy projection from
I mean,
my seat.
it could be possible. I mean, one of the guys, my head of operations, I think he's like 32. He's never bought an equity. He has
Wow.
only ever bought crypto. Like, Murray, you won't even buy any of our ETFs. He's like, only the ones that have crypto. But he goes and has his hard wallet and all this other stuff. So he won't even buy ETFs. So small sample size, but yeah, could be.
Yeah. I know your answer is going to be like the heat method here, but like, what is, like, if you're giving advice to someone who's just starting out in investing, we've got some viewers, a lot of our viewers are, in the prime of their career, or even older, but there are some who are probably, still in school, maybe getting started in their investment. They're interested in Bitcoin. They're interested in Bitcoin treasuries. But what advice do you have, like, saying, you've got probably their traditional teaching that say, go with the traditional index investing, stick with the S&P 500, stick with the, maybe a, 80-20 equity
No,
bond
no, no,
portfolio or
no.
something. What's your advice to that person?
So I would go back to what I said before, how we tell people to construct portfolios. 20 in our base case, 25% thematic equities, 25%, beyond bonds, 25% hard money hedge, 25% tail risk. That being said, if you are just starting out, you may say, you know what? I want to take a lot more risk. All right. Yeah, I suppose you could do that, you know, like SMH, which semiconductors, something like that. Understand it's going to be a wild ride. At some point, you're going to have a 60% drawdown. But that being said, the time to learn those lessons is when you're young. So just starting out, so I was in college in the late 80s. And back then it was, Michael Milken, takeover speculation. And what we would do is anytime there was an article in the Wall Street Journal about takeover speculation, I'd buy call options on the company. I made money every single time. I thought I was going to be a millionaire. Clock flip 1990. Michael Milken went to jail. I lost like probably 10 trades in a row. Every cent I had, I basically lost. That was the best investing lesson ever. That's probably, now I didn't go from there to the heat formula, but that was certainly the start of, all right, that didn't work. Let's try to figure out what does. And, losing all your money when you're 21 is a whole lot different than losing all your money when you're 57.
Hmm.
So if you're younger and just starting out and you're like, hey, I want to be more aggressive. So yeah, I've got three kids. They're all in their 20s. Two of them invest very aggressively in their portfolio. And one of them, I mean, I'll get calls from him like, oh my God, Dad, I'm up so much. I'm like, just understand, you're going to give some of that back. Oh, no, no, no. Then I'll call, oh my God, this week, oh, I lost so much money. I'm like, I told you. But that is what it is. If you want to, and he's like, SMH and QQQ, and that's it. So it's gonna be a wild ride, but if you can hold on to it for 25 years and not panic,
Hmm.
yeah, I mean you're gonna be in great shape. But it's gonna be hairy, and that's why I like my portfolio construction because it's not gonna be hairy. You're not gonna have the same types of drawdowns and, but again, I'm 57 years old. I don't need to double my money in a year, but I can't take a 50% drawdown.
I love that. I love that. It's understated point. You can afford to lose all your money at 21, but not 57.
I
I
mean,
think
it's
that's
still, I'm not saying do that,
sure,
but you can afford to
but
do
it's
that.
tolerable.
So,
Absolutely.
like,
What
and I'm saying that because you've got some 21-year-old, like, that portfolio construction just sounds boring. Like, yeah, I mean, it is.
I'm curious, how do you anticipate your portfolio construction changing? Will it as you get older? And how should someone who's on the brink of retirement or maybe already in retirement, who may be relying on some income from their portfolio, approach things?
So, I don't think age has anything to do with it. I think you need to have a smart portfolio construction, regardless, of your age. So, I don't believe the old, and again, I hate bonds, but the old advice would be I should have 57% bonds because I'm 57 years old. I have
That sounds insane to
0%
me. That
bonds.
sounds absolutely insane. But
Right.
go
I have
ahead.
0% bonds except for what I have in cash is in T-bills. But beyond that, I have zero.
Right.
So I don't think your portfolio construction changes as long as you've got a smart strategy. And again, anyone thinking bonds are safer, look at 2022, look at Liberation Day, look at this whole Iran war, and understand. And again, you said this is coming out in August, but shouldn't change. We are sitting here with the possibility of the Fed undergoing a hiking cycle, which they did in 2022. TLT, which is the 20-year Treasury bond ETF, was down 31% in 2022. So food for thought. The
Yeah.
income side, I think, it goes back to what I said. Have some of the digital credit in there. Have some put spread stuff in there that can augment your capital gains and then come up with a withdrawal rate where if you're doing things right should be somewhere between 6 and 8% that you can pull out of your portfolio every year and keep the portfolio growing over time, which is extremely important. Again, what we said about social security, I would not count on it. The other key component which nobody in my industry is thinking about is longevity. So, I've talked to longevity people, and by and large, they tell me the same thing. If we can live for another 10 years, the only thing that's going to kill us is stupidity. They'll be able to solve, oh my, your heart is giving out. Great, I'll just 3D print you a new one.
Yeah.
Bad liver? Here's a new liver. Let's go. All of that stuff will be fixable. And if it is, all of these things saying you're going to die at 85 go out the window. And you've got to be prepared to live for much longer than that.
Yeah. I got to think, maybe we can touch on this in a bit, what that might mean for equities and in that world. where there's money to be made in investing, where where that lands. But before we maybe click on that, and I know we're coming up against our time here, Matt, but talking macro, I guess in retrospect, you mentioned the hiking cycle that Powell went through back in 2022. Some things broke. We went through like maybe a short technical recession, and we had the Silicon Valley Bank, First Republic, all that kind of as downstream consequences of some asset liability mismanagement at banks. But how well did Powell do? And then what do you think Kevin Warsh, as the new Fed chair, can take away from how Powell acted?
So I'm not a fan of the Fed in general. I don't think Powell did a good job because he theoretically had to do what he did. We'll never know what would have happened if he didn't, but we know what happened when he did. And, and there were some consequences of it. They got it wrong. They called inflation transitory. It wasn't. I don't know that Warsh is going to be any better. I don't know if he can be. Again, I'm not a fan of the Fed, the whole idea of the Fed.
I want to talk about something that comes up in almost every conversation I have with Treasury executives. They get the Bitcoin thesis, they see the macro case, but then they walk into a board meeting and the first question is, who's holding it? Are they regulated? Are they insured? Can we audit this? That's where BitGo comes in. BitGo is an OCC-regulated national trust bank. That means they operate under the same federal oversight as the institutions your board already trusts. Your assets are held in segregated trust accounts, never commingled. They're secured in 100% cold storage with multi-signature architecture. If you're building a case for Bitcoin on your balance sheet, BitGo is the custody partner that turns a board conversation from why into when. Visit bitgo.com/Bitcoin-Treasury to connect with their team.
You wish for it, Bitcoin is finally on sale. And if you're sitting on BTC and want liquidity without dumping your stack, Arch Lending can make it easy. You can get USD or USDC in minutes, and your collateral stays in qualified custody. They never rehypothecate your assets. As your assets move up and down in value, you can scale your credit line instantly or pull collateral back when the market runs. If you need help, you get real humans 24/7, not bots. This is Arch Lending. Simple tiers, public pricing. You can check them out at archlending.com.
We'll see. We're in a tricky situation right now with this war. Maybe by the time this video comes out, it will actually be over. I doubt it. We'll get headlines and tweets that it's over, and then somehow it's not over. And, and oil prices are going up, interest rates are going up. I've been writing in our newsletter, if you see the 10-year go over 5, that's going to be a tough time to own equities with a 10-year over 5. And I think it's around 4.6, give or take, as we're filming this. Who knows when it'll be when you put this out. But yeah, the Fed's never really wowed me, and certainly don't like the way they handled 2021, 2022.
Yeah, I think I share that sentiment. Certainly not impressed by the Fed. That's no surprise to anyone in the audience, who watches the podcast. I think the big misstep was just the reaction to COVID in the first place. Just like overspending, shouldn't have crashed rates to zero. I get why they did, they're trying to manage panic or whatnot, but I think that was a huge mistake that we'll look back on, and history will look disfavorably on that period and the reaction, I guess, to and the shutdowns in general.
And we're seeing that. So like guys like me, I don't get affected. I am wealthier than I was back then. All of the stuff going on in the economy right now, everything the Fed is doing, it all benefits me.
Yeah.
Guys like you're screwed.
Yeah.
You can't afford a house. The American dream of go to college, get out, get a job, get married, buy a house, 2 kids, 2 cars, 2 TVs, all that stuff. The stuff that I did, you can't do. People your age can't do. And now we're seeing it on the political side. You guys are getting pissed. And and I can't blame you for getting pissed. So, we're seeing that pushback now in a big way.
Yeah, me and my friends call that, for my friends who are still, haven't been able to unlock that. We call it they're getting roommate fatigue, and I think that is something to monitor. Especially I think the age cohort even a little bit younger than me. If they can't get into housing that's affordable, pursue that American dream that kind of we saw our families be able to benefit from. We were in a secular equity and bond bull market for 40 years, and yeah, I think there's going to be some resentment. I think there's going to be some political turmoil, and I don't know how that plays out, but yeah, it's gonna be interesting to monitor. I think everything I've taken away from Kevin Warsh's public comments, tells me he's going to be a little more hawkish, maybe communicate less than the Fed has done in the past. But a lot of Bitcoiners that I talk to think he's going to have no choice but to cut, to kind of grease the wheels in the system, keep the banking system running, because
he's going to have some pressure. He was Trump's pick. Yep. We know Trump wants interest rates lower. We'll see what happens.
Yep. All right. I mean, this has been a great conversation, Matt. Maybe tell us more about where people can read your newsletter. Learn more about your ETFs and what you've got in the pipeline. You've got a book coming out next year, and where can everyone follow you?
Yeah, so go to my website, tuttlecap.com, TUTTLECAP.com. There'll be a pop-up for my newsletter. It's free. We every day we put out a lot. If it's too much, just unsubscribe. I don't care. It is what it is. Our ETFs are listed up there. You can also follow me at Twitter. I'm at Tuttle Capital. I go in spurts. Sometimes I'm really active on Twitter. Other times I'm not, but I try to post as much as I can. Try to give, different ideas and trading things and stocks I'm watching and all that stuff.
Love it. This has been a great conversation. I know the audience is going to love it, Matt, and we're keen to follow the digital credit ETF as soon as that gets the green light. And one thing I have all my guests say before they leave, this is a Bitcoin podcast after all, so is stay orange.
So, all right. So you want me to say it?
If you don't mind,
No, not a problem. Stay orange.
I love it. Stay orange. I'm wearing the shirt today, actually. I gotta
nice.
Stay orange. But
you should have told me. I would have had one made up. I'm wearing my GBA championship shirt.
I love it, ladies and gentlemen. From Tuttle Capital, Matt Tuttle. Make sure you like and subscribe. We've got all the links to his stuff in the show notes, and make sure you head over to bitcointreasuries.net/conference to reserve your seat. We've only got a couple hundred seats left for the upcoming Bitcoin Treasuries conference that happens in New York City, September 28th. But stay orange, and we'll see you next time.